Let's discuss what all this latest M&A action in the oil industry means for the sector. Joining us here at Post 9 is Paul Sankey of Sankey Research, president, of course, lead analyst. Paul, nice to have you here.
Hi.
I guess both sides give it to me because I was asking Hess sort of why and why now to Chevron, especially given the price. But give me your take from the Chevron side and the Hess side as to whether you think it's a good deal.
Well, look, we know Guyana is the best asset in global oil. It's remarkable. So Hess was trading as a takeover play. And the question was, can you get a high enough premium for it actually to be a consummated deal? And as you said, the question then becomes for John Hess, why now and why at this price? Hess stock last week at an all-time high, so, that's good. But just a 5% premium to that price, which is kind of bad. And this is by far the best remaining independent oil company out there on the U.S. exchange. So it is a little bit of a light price, and that does raise questions for the rest of the sector, I think, who don't have the asset base of Hess.
And for Chevron, just...
Yeah, it's just a great deal. I mean, Chevron's heavily exposed to Kazakhstan, which has to travel through Russia. That's a big part of their next 10 years. They're very, very good in the Permian, so if they buy in the Permian, they're going to dilute themselves. So really, it was a question of can Chevron get Hess? Frankly, I didn't think they could. I'm delighted for Chevron. And I think for John Hess, it's a tremendous end to his career as a CEO.
Why didn't you think Chevron could get them?
Because I didn't think they'd get it for 5% premium. Right. I thought we were talking 200 a share. That's in range with the highest price targets on the street. So you're $20 below that, and that was the stretch target. Let's say the average street price target is 170, around where it went out. But of course, that doesn't include a takeover premium. So.
Does it mean there's more consolidation in shale, at least?
I think the knee-jerk would be it's bad for Oxy. I think there was hope that Chevron would do Oxy amongst the Oxy shareholders, maybe Mr. Buffett included, because, of course, Mr. Buffett owns both Chevron and Oxy stock. And then there's a second rank, if you want, of companies where what we're seeing here is the medium-ranked companies are getting a poor multiple. And as you get bigger, you get a better multiple. So the bigger, the better right now in oil. The highest multiples are Exxon and Chevron. The next was Hess. The question is, how do these guys, in a synergistic way, in a good-for-all shareholders way, combine, let's say, someone like Devon and Marathon Oil, someone like Devon and Avintiv, someone like Avintiv and someone else. These guys really need to get bigger. And as you know, we had other rumors last week around Chesapeake and other names that you'd be doing similar deals to just scale up and get bigger.
Because the two big guys are done for a while. They're going to be digesting large deals.
Absolutely. They have to be done. So that's why I say it's a little bit of a negative for Oxy here.
Are the regulators going to let all this happen?
Got to go down to Guyana and ask them. But I think there isn't really a major issue with intra-Texas deals. There isn't a big issue here. I think if you just flip out Hess for Chevron, it doesn't really change the competitive landscape. I do think Exxon for Hess would have been much more of a challenge because, of course, that would have worried the Guyanese. Probably you would have had a lot more concentration to just the one big oil. And I think that the Guyanese, I assume they liked having John Hess around to sort of keep everyone honest. Mike Wirth is no less honest. So, it all adds up. It's sort of a win-win, if we dare say it.